None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Well, you might notice we're all dressed up and looking professional today. We've got a new screen that we're coming into and starting off a new season. I guess with summer being over, can't play summertime blues, even though the market seems to still be stuck in summertime blues yet. Anyway, we're hoping to kick off the season, and we'll be announcing next week what our full schedule is going to look like and some of the items that we plan on covering. And I'm not sure what that'll look like just yet. We're going to have a meeting this week to make a final determination. The other thing that is going to be happening, you're going to need a ticket to get in. We're going to kind of close the door to everyone except for those of us that are being invited into the show. And that's gonna give us a better control of what we know is going on. We've run the program completely from a public viewpoint for a while here, and we're going to start making some changes here. We're working on a couple things that have to be done. We're also, further announcements here, that we're also looking at hopefully having the Market Mind project out on the street here very, very soon. We have all the files together. We've got a couple web pages to get together, and then a video or two just to get you started. And then once we know, I think what I'm going to do is start a TradeStation Market Mind Club, and we may have our own little special meetings, a study group of a sort. So we'll talk about that as well, just some things I'm telling you a little bit about what's going on. So kicking off Monday morning after I guess the run on Friday, Mitch and I were just talking about that it was virtually nothing. What was it? 43 stocks were net buys or something. So, right. And I mentioned this in commentary that there's no new trends developing here. The fact that we closed at 2007 after being at 90, rallying, basically looking for, I'm sorry, I lost my train of thought there, but. I haven't had too many glitches like this, but anyway, I was thinking we haven't had many bloopers on this show yet, so we've been pretty solid. I guess maybe we'll call that one. But the bottom line is we're continuing to see the market in this trading range. I'm sick of 2000 right now. It's just a really good, I guess it's one of these things where we're in this sideways range I talked about in commentary. The 2011 to 2009 or 1995 is kind of a trading range I'm looking at. We got down to 2087 so far today, and we've seen it's interesting, and we'll go through when we talk about some of the technicals and bring up some of these screens. But we're looking at some of the values that are out there. The 3-day indicator on VPM is at 15.80 right now, and the weekly is at 23.99. So as volatility has increased over the last several days, we've seen these get very similar. So when you look at, we always post on Mondays. If you don't notice on commentary at the bottom, we always have the weekly and daily numbers, and so these numbers are becoming somewhat similar. The extreme for the day for today is 2023.50, and the extreme for the week is 2031.70. So that tells me, just by watching these ranges for 100 years now, I think it's been, you really, when you start to see this type of thing happen, then it's really a trading range kind of market. Because typically what you'll have is the short term will lead into the weekly numbers, and with the weekly numbers being, they've even contracted as we've watched this volatility stay fairly low. And that those events I think will continue to unfold. And Mitch and I were talking offline here, just a couple little notes of things we were talking about. I thought it was kind of interesting how Japan can be in a full-out depression, but no one cares. Even the people in Japan, evidently. It's, they 7.1 minus GDP. What the heck is that? I mean, I don't even know what to say about that, And then Germany's got 2 quarters now of a negative GDP. No one cares. France is on the verge of one. Italy's in a full-out recession. Greece is not much further along than they were. They're still on a default watch for their sovereign debt, even though their rates, I think Italian rates have dropped from 7% all the way into the 2% range, mainly because the bonds are trading at under $1, and you got negative rates in Europe. And and I think the concept here is, folks, is that everybody's expecting that the central bank's going to fix everything. Meanwhile, they've been fixing it since 2011, and it ain't working. But somehow the expectation from the market standpoint is looking like they want to like everything's okay, and it really isn't. So I think the other thing is we see all types of, no matter what type of news you watch, there's some bias in everything, and the bottom line is, you see bias in watching CNBC. You see all types of things from the standpoint of their posturing, how they want investors to think. And I had a buddy that had been on CNBC a fair amount, talked to some of the production people, and there's a guy calling the shots in their little ear, telling them what to say, and they've got all kinds of talking points on their teleprompters and different elements around there because they want to message to the public, and it depends on what they think the message is. And when things are bad, then it's there's buy dips. I mean, they're always trying to perpetuate the bull market, I think. I've said this before probably 10 times now, but record Squawk Box Europe, you'll see some pretty honest reporting. I've always been very impressed by them, and that's if I watch any news, I get a little different perspective from doing that. And I think that what we're seeing across the board here is just that bias pour out, and so here we are at we dropped down to 2,000 again, and they've got their hands out to catch it. So, Mitchell, what were the other things that we were talking about on some of the news there that was going on?
One of the other items, of course, is the UK, the potential demise of the UK.
They even got the Queen in a tizzy on this one. She's freaking out that the monarchy is going to collapse, and I think she probably should, but anyway.
Yeah, so there's that. Also, we've talked about Germany, the fact that they're just bringing in record amounts of fuel into their country to replenish all the storage that they had used up this last winter because of how rough it was, plus the potential squeeze that they may get from Russia because their ongoing spat as far as sanctions against one another really is only hurting the European Union as opposed to Russia at this point.
Yeah, and the fact that I'm living in Seattle, but I'm really in Scottsdale, Arizona, and it's raining here endlessly. I think it might be warmer in Minnesota than it is here today. It's like 72 degrees. So, global melting is not happening, I guess. Anyway, but getting on to the markets here, the whole backdrop and the reason why on the commentary talked about this week's going to be more about Europe than anything, because there's some news coming out on Wednesday and Thursday, both I think industrial production and production type numbers, and there's a slew of reports coming out later this week, all out of Europe. There's nothing going on here.
Well, even just thinking about last Friday, even the reports that did come out, the commentators, the market analysts, they just sort of brushed it aside, even though they had the latest facts available. They just said this is irrelevant. It's an anomaly. The fact that we had the jobs just sort of decrease out of the blue, supposedly. So really, this is a sentiment-driven market.
Well,
sentiment's carrying forward.
Yeah, we talked about that on Friday. Is that somehow August is always this rogue month, but yet everybody had these big expectations. So and then all of a sudden, when it happened, they go, "Oh yeah, August is a rogue month. This doesn't matter." Bottom line is, even if they do raise them, and you've got June and July were both revised downward. Maybe we get a revision up on this thing. These numbers are pretty volatile anyway, and it doesn't look like in the end of the day that the markets care about anything as far as that goes. So I think the only thing that we're looking at here now is, the Ukrainian situation's back on page 48 now. It's there. There's a ceasefire, sort of, even though they were bombing each other last night. Like, ceasefires are kind of interesting anymore, but we see that in Palestine and with Israel all the time. There's a ceasefire, but it's really not a ceasefire. I think they should call it a slowdown, maybe not a cease. Because maybe I don't think I don't think that word means what they think it means. But anyway. So all of these things are affecting the markets, and there's just nothing here in the United States. So I can see there's no earnings right now. There's no, we don't care about the numbers that do come out, and it's all about the central banks yet. And I think at some stage that we all wake up and realize that the central banks are in this little mini nanny state thing that they're putting together isn't going to work out in the end. So let's go ahead and get started on the markets here today. But there was nothing else, right, Mitch? We were all good with that.
That's pretty much it. I mean, it's those main headlines overseas.
All right. Well, let's get over here and start cranking away on some of these markets and the activity. I've got this on a monthly. Let me go over to the daily chart here real quick. I think it's interesting to see what's going on from a momentum standpoint. And I talked about this last week. We saw this increase, and we went all the way down to the 1905 level, and we rallied all the way up to 2011, and now we're flat. And the moving averages it's interesting because the underlying average here, when we look at, let me bring up the numbers here on the sheet, and when we look at the actual numbers here from the PPMs, you'll see at the very bottom of this column I just brought up, you'll see that PPM1 is 0.07 right now. This is in the red numbers, is the actual value. The other two are the first and second derivatives. And PPM2 now is 22.22 and 0.04. So it's interesting, as the market's been going sideways, the 21 period moving average and the momentum on PPM2 is starting to increase. We're almost at a trend level, which suggests that if the market declines down to that level, we would see a bounce off that level. And right now that level is 1980. And if you look at the weekly numbers that are on the sheets this week, you'll see that 1893.70 was actually the extreme for the week. So even if we did decline down, we've got some pretty good support underneath this market. So it's not going to roll over right now, but we are starting to see some vulnerabilities. And I'll continue the story that I started last week that was talking about the what's going on with the monthly graphs and these longer term trends, because we're finally seeing some things start to switch around. The dailies, it's like watching grass grow right now. So we'll switch over to the weekly and the intermediate charts here. And what we've got here is a pretty similar situation where we've got short term. If you look at the PPMs here, 0.08 on the weekly, 0.34. So we're still in a trend mode on PPM2 and 0.26 on the PPM3, and that has decreased a bit from where we were. I believe we're at 0.43. Let's see here if I can bring that up. 3.4. Yeah, so we were 3.4. Now we're still. It's not updating here. Here we go. 3.4. There is 47. So we're seeing that it start to decrease, even though the trend is still in trend mode. We're starting to see it roll over. And if you notice over here on the right-hand side where my cursor is, you'll see that there is the indicator is starting to cross through its first and second in derivatives. And what that tells me is that there's a likelihood that the momentum's going to go out and that we could see the market decline at least to that level, which is that level is 1945, and then the longer term average is 1892. So ultimately, I think we retest this 1905 level that was printed some weeks ago now, I guess about 3-4 weeks ago. And I think that's still in the cards. Maybe we can hang around this 2000 and get up. I noticed that Goldman Sachs now has joined, not quite as crazy as the boys over at Morgan Stanley. They're talking about 3,000 S&P, and Goldman was talking about one of the old objectives that was negated around the 2140 range, and looking at for the next year as far as that goes. And you're just not, we'll have to see how this thing evolves. But for right now, there are just tons and tons of stocks that, and we'll go through the typical database review that we do every week. But there's tons and tons of stocks that are just not moving, and the ones that are moving are getting a little bit narrower every week as we go on. So, but on a weekly basis, so the trends are still alive underneath the market, but the support levels are a ways below. So the range would be a 1945 to the 1892 level, and those numbers are rising at about 0.25% per week. So they'll catch up with the market, but the problem is if the market stays sideways, we're going to lose all the momentum. And when it does, when we get to the point where the markets are trading at those values, there's going to be a high level of probability for them to get through that point. And like I said, I still think we all wake up one day and realize that all this central bank stuff really isn't working. Probably the best thing that's working is here in America, because we tend to want to spend our money. Europeans, the Germans, it was funny, I saw a guy on CNBC Europe last week, and he said, well, the problem is the Germans are saving too much money. They're too conservative. And so, but they're not spending their money. There's nobody conservative here. I think there's so many people in this country live, payday to payday, and they get a couple extra bucks, and that's the way that goes out.
Well, I remember over the last couple of years, there's been additional reports coming out as far as the use of credit cards and how it was declining, the total balance of all the different credit card companies.
Right.
And they were doing that. They were saying it as if it were a bad thing, because now these people are finally trying to rein in their own personal debt, and this is a bad thing because they're not going out and stimulating the economy.
Well, let's face it, and just probably should be a whole show just on debt and what's gone on with corporate debt as well as sovereign debt and everything that we've seen since the crisis, which we had this mortgage debt crisis, right? We've just ballooned everything to a max. This entire system is leveraged to a point that is scary, to say the least. And I know I'm glad that VPM's around, because I know one day this thing's going to roll over, and I'm going to be glad I know myself, I guess. I'm glad I know what I know, and that's really the fears that continue to be in the market. And it was interesting that everybody from Buffett, even George Soros, I hate to even mention his name on air, guy is just like the evil one, but all of the big guys, Zell and all these big multi-billion-dollar investors, guess what they're doing? They're raising cash. They got lots and lots of cash. They're putting on big-time hedges on the S&P. I forget, Soros has I forget how many billions of dollars of hedges he's got on the S&P to go down, just in case, because you just don't know. And that's the point of hedging. That's the point of us having cash right now, is there is more risk than meets the eye. And I've said this before, but if you're going to sell, what a great place to sell up here at 1,900 to 2,000. We weren't one of those guys like our buddy Hussman, who has been negative since 600. Still hasn't bought anything. His funds are negative. I don't get it. But anyway, I saw another story with his name in it. My mouth drops every time I see that. He's got a good publicist. I know that. I do know that. But the bottom line is, as far as being right in the markets, he doesn't know much about that. So moving on, I'm going to go off screen here and take a look at the monthly graph, because I think this is really important from the standpoint of looking at what's happening on the big trend. And bringing up the whiteboard here, I think it's important to understand exactly what's going on here. And for the very, very first time, we've got PPM1 104, 158, and 106 on the PPM3. The very first time what we've got going here, I'm going to get my pencil out and see if I can draw. But I think what's going to happen, I'm going to draw this red line the best I can. But this moving average is going to start to roll over here. And then we're going to start to see these averages here start to go flat. And then last but not least, we get the this final average just to kind of go over here. And what will happen is I even did that in the right colors. That's pretty impressive. What's going to happen is this is going to cross through here, and just like it did here, just like it did over here. And these are monthly graphs, so this is a very, very big trend. And it's going to be a most likely. It's interesting to watch these things, because you usually get about in 2000 we got about a 1.5 year decline. It was about a year and 4 or 5 months here in 2008. I suspect we get a pretty good whacking at some stage. But as I've mentioned several times, I'm just kind of emphasizing this, is that what's happening here is really, this is not at the tipping point just yet. There's still at least, I'm going to guess, to the end of the year, maybe even January or February, before this thing has some serious vulnerability. Anything could happen here from a geopolitical side and trigger this thing, but you got, because of this average at 1.04, the 1885 level that I talked about some time ago will be in play at that time, and that's going to be a point where we're at least going to stabilize there, probably see a bounce, and then that next rally will be the last one probably for a while when these events happen. For right now, I mentioned in commentary last night, there's some objectives out there that 2031 to 2034 are still likely objectives. The extreme allowed right now is 2070, so it's not that far off of the Goldman number. And by the way, the Goldman, they're only bullish for the next 3 months. So no one looks out beyond the next 3 minutes, next 3 weeks, or next 3 months, I guess. That's how this thing works anymore. So you're really looking at I think the final stages of this topping pattern happening, and you can see now, just looking at the, trying to find my cursor, I lost it. There it is. You're looking at these PPMs just on the verge of just rolling over all of these. And what that means is that they go into a negative output, and once they get there, then we have downtrends forming, and once that happens, it takes a while for these things to turn around. And if you notice, none of these have happened on this chart where I have arrows up here at the top. All of these rollovers, none of those like kind of start where they roll all the way over and then just reverse again. There's none of them that have done that. And I can go back even further. I can go back to 98. I can go back to 87. these things. I've talked about this before, and I think this long-term perspective is one to really keep a good track on, because this is really what's going to drive the markets here. Probably in 2015 isn't going to be that good a year. And as it probably turns out, interesting that the end of these presidential cycles, by the time we get another year and a half out and we get to 2016, you're going to look at probably just a really terrible market that whoever gets into office then is going to inherit another really bad situation probably. And we've had a good cycle from a market standpoint. We just haven't had a good cycle from an economic standpoint. And I talked about this probably 3 years ago, that corporations would learn how to make money in these low GDP 2 to 3%, and they've done just that. That's why unemployment's like it is. It's stayed reasonably at 6.1, sort of, kind of. U6 is 12%. It's actually declined year over year, but only less than 1% in the last year. So it's still, there's a lot of people underemployed, and not to even mention the participation rate, how incredibly stupid that is. So
down to, I think it was 1978 numbers I saw on Friday. So it's tied for the lowest for this year, and it's the lowest since 1978. That's just amazing to me.
Yeah, and think about that. Since 1978, the population is probably a third bigger. This country is a third bigger than it was. There are 200 million, now there's 300 million.
Yeah.
And just looking, and that's even a bigger number when you look at the relative number from the standpoint of the number of people in this country. And let's face it, central banks, the only thing it's done is made the rich richer, in spite of all the redistribution scare and all the crud that we've worried about. It's been the opposite. If you own stocks, what was it, Mitch? It was funny, we were talking about this, is that somehow it takes them 2 years to figure out how much participation in the stock market. What was it, 2012, 41, 48?
There's a headline from the Fed that the latest data they had, from which was 2012, showed that the stock ownership rate was the lowest, I think, since 1995, somewhere around 48.5%.
Right.
So it's been steadily declining, which makes sense. A lot of people, they don't want to be stock pickers. They'd rather just own the index, because that's the easy way out.
But even if you own the index guy's got to buy something. So you're still buying stocks. So I just think people don't own stocks.
They're only owning the actual assets. They're not going out and actually acquiring the stocks themselves.
No, but the funds are. So they have to buy that. So but there's another issue going on here. Is just that people have lost a lot of faith in the markets, and I'm sure all of us that sit around talking to clients, we hear this all the time. I was talking to somebody a couple of weeks ago. They're talking about no one even knew what. 5 years ago, you asked somebody what the S&P was, they couldn't tell you. Ask them today, they can tell you exactly what it is. So the focus on the Dow Jones has certainly changed a lot from what it was. So anyway, let's go through a couple more things here just on the markets, and then we'll get back to the actual go through the database real quick so we can get on that. I think Mondays take a lot longer to get through these markets, because while there doesn't seem to be much happening, I think this spending the time, this extra time on the longer term trends is significant, I think. Let me just, I'm going to turn the disable the strategies for a second here. I've actually got both on here. Let's go and take a quick look just for fun. We haven't done this for a while to see. I hate this range that's come up. Let me see if I can get a little better range here. Oh, that's why it's on a daily. Let me get to a weekly here. You can see that the yen is actually moving down lower. You would hope, right? I had expectations, and that position has been let go is about the same time that the gold was let go. None of these assets are working anymore, and you got, I guess the only reality is in the Japanese currency, and the nuclear option that they took from the central bank standpoint to stimulate didn't do a very good job. And if you want to know whether tax increases affect the economy, just look at Japan. They raised, what was it, Mitch, we were talking about, they raised their tax rate by, double almost, from 4 to 8%?
5 to 8%, yeah,
5 to
pretty
8.
much doubling it.
Yeah, and,
And
just...
they're wondering why they have a 7.1%.
Yeah, so, if you want to know when you increase taxes, what the effects on the economy are, there you have it. Yeah, you got a real time efforts there to see that. So anyway, let's take a look real quick at the treasuries, and they have moved back up from their lows, and there's a magic number here. Not sure why the scaling is coming up kind of funky here. Let me grab this. Oh, I know why it's doing this. Let's just put this up here like this. So you can see a little better here from a treasury standpoint. They're starting to move back up. We're starting to see the PPMs break out on these PPMs are turning up. Right now they're still very negative, minus 0.29. I'm in front of these numbers, so I'll read them off. Minus 0.30 and minus 2.6. So all three averages are in trend mode on the downside, and where those are coming in at is right here. We've got 2.44. We're right there right now. We're just above that average. The next one is 2.51 and 2.63. So for me, when this thing starts to move just a bit higher, we close above the 21 period moving average at the let's call it 252. When that happens, that's going to trigger a move to the 263 to the 268 number. And 268 was that magical little high we had a couple months ago. Anybody that's a bond trader knows the 303 level, the 3% level is a key tipping point. And I think before that, the key tipping point for me is around the 252 level. There's some getting through this 245 level is probably the beginnings of running to the 252. When we get through that, then that's going to tell us there's a tipping point going on, and 268, 272, then possibility of running up. So if rates are going to increase, is that going to be a precursor to the Fed actually increasing, or the market's going to increase the rates for the Fed, which has happened a lot. The tail does wag the dog once in a while. So, yeah, so we're seeing those kind of things happen here with the interest rates, and really no need. We don't own gold. I'm not going to talk about it. If you like gold, good for you. There's no reason to like gold right now. You just need to have there's no position from our viewpoint. So there's no reason to talk about what it might do. As far as everything else goes, it's interesting. Remember the big boom in corn? Well, that's no longer. There's so much corn out there right now. They don't know what to do with it. It's all going to rot, I think. They're going to have to turn it into Coca-Cola corn syrup. Maybe it'll have a longer shelf life, because there's just no real demand, and people figured out the whole biofuels are a joke.
Ethanol, yeah.
Yeah, and boy, the boom! I tell you, if you own farmland and you sold it in the last 5-6 years during that boom, you were really in good shape. You nailed it. There were some crazy numbers coming out of farmland, and having grown up in the great cornfield of Indiana, I used to be in the real estate business. We used to sell some farms, and that stuff was it was really good if you owned it. If you still own it, you can still get it, but now nobody wants it. So, and not as much as they did anyway. A lot of big corporations came in and snapped up a lot of land and drove a lot of things up, because that was the big boom, which is maybe not so much now that we have horizontal fracking and everything else, and earthquakes in Oklahoma. Well, we got all the oil that we can think of, so who needs biofuels? Anyway, so from an interest rate standpoint, we're at tipping point 245, 262, 268 is the next range above that. I suspect we're going there, and and that's on the treasuries. We did see some influx. Mitch, I'm going to bring you up next, and we're going to go through the database.
Okay.
Matter of fact, I'll bring you up on screen here, and then so we can do a transition over. But I believe I would like you to go through and look at the bonds, all the munis, and all the other segments of the bond market, and I'll interact with you on that. I think those are areas that we want to make sure that we're talking about right now, and that we have some sort of perspective of what's going on. I know there was utilities have been bought recently and all that. I don't know if that's going to be a fluke. I don't think we bought them real heavy, but we did add some positions in that level. So maybe we'll put a little dialogue around that for a portion of the show here this morning. So let's go ahead and get you on the. So
All right.
you can go ahead and drive.
Let me scroll down a little bit here. So let's jump right over.
Now go.
All right, sorry about that, folks. So as I was saying, last week we really didn't have that much activity. We had 43 net buys on the stock side. That's on the optimized weekly. On the mutual fund side, we had 2 sells when all was said and done on the net optimized funds. So last week is a great example. Bob and I often talk about on Fridays that when we just barely end the week slightly positive or slightly negative, that last week just didn't happen. Nothing took place other than it just caused the loss of momentum on a daily or a weekly level. And so when we take a look at the database here on the mutual fund side, we really didn't have a ton of activity, as I mentioned, but we will jump down to the bond side, and we'll take a look and see just what exactly we had as far as activity. I think we had some activity on the municipal bonds. So all you have to do is scroll down the page a little bit, and we'll select the municipal bond sector first. And this will refresh the area down beneath it. So here you see we didn't have too much activity. We did have a little bit of buying on the single state long, so the municipal bonds. And as you can see right here, we're somewhere between the 70% and I'd say 85-90% invested. We have some of these different municipalities fully pegged out. So I'd say when it comes to the overall investment exposure, as you can see here, we're right around 90% invested of all the different municipal bond funds in our system. So that's the place of our largest investment exposure on the mutual fund side of things. Now, if we look over to the taxable bond fund, we did have some selling last week, both in the inflation protected as well as the global bond space. We sold off 16% of all the global bonds. So this, as you can see here, about 65% of all the taxable bonds that we monitor in the system are invested. The rest we either just sold out of or have been out of for some time. And you can compare that to the U.S. equity fund side of things, where we're still pretty heavily invested on the domestic large growth funds. 62% of all the large cap growth funds that we track are invested. And you can see all the rest are somewhere between this 5 and 25% invested range. So if you're not owning a large growth in your portfolio, chances are you're sitting in cash at this time, just because we just don't own that much in the way of the domestic equity markets. Those advisors with large stakes in either municipalities or also in taxable bonds, they're going to see those portfolios more heavily invested. But at this point, I mean, we're waiting for some sort of trend to emerge, and it's just not taking place on the domestic markets. Certainly not favorable trends, at least. Weekly research, this side of the dashboard, this just covers a lot of the most commonly used ETFs in our system, as well as the single country ETFs that iShares puts out. This week is another great example where there just really wasn't much activity across the database. I did see that we had one buy in Turkey, but all the rest, I mean, it's just status quo at this point. We're just holding on to the current positions for those that we have. The rest, we're sitting on the sidelines, and we're waiting for the markets to give us something. And at this point, it's not really doing much.
I think, Mitch, real quick, I wanted to make a comment that I think that this is pretty reflective of what I was talking about a little bit ago from the standpoint of, how the markets are configured across the planet, just not here. And investors, from this most standpoint, is because we're trend followers, we're looking at really cash flow into these different items in here, and there isn't any. And
Right.
and there shouldn't be, because there's nothing, you're looking at like just, Japan down 7%. Let's go buy Japan. No, maybe I'll wait. Germany, all these different entities. And, you can see, what is this year to date that Mitch just brought up on the screen here? You can see Russia's the big negative and down 11%. That pretty much everyone else is positive, with the exception, looks like Argentina's down.
Yeah, the Euro countries, for the most part, are all down. A lot of the big players. What's sort of interesting is last week, Russia made news by having a nice 6% increase in their performance just last week. So they saw some nice rallying, and it cut its losses from around 15% on the year to around 11%. And then you take a look at Japan, and they just announced that the second quarter for this year had a 7.1% pullback, and their year-to-date performance is only 2.39%. So a lot of these markets aren't even reflecting what actually is taking place as far as the actual economics. It's all headline-driven at this point.
Well, headline-driven and central bank expectations, and that's what's driving the entire sentiment. And you think about that, I don't know, when you start to see what's really going on in the world, I wouldn't be surprised, depending on what happens, if we don't see a bounce in Europe, that the ECB's asset purchases and other things start to work, that we don't start to get some talk about the breakup of Europe, and we're potentially going to see, the breakup of the UK here right in front of our eyes. And it was unexpected. That's one of those events. And I didn't get a chance to watch any Squawk Box last night to see what the boys in London had to say about it. But I'm sure everybody's got kind of it's brought on a lot of anxiety from the standpoint of what's going on the planet. So if the UK breaks down, you've got Ireland, you've got Scotland. They just don't want to be part of the club anymore. The 300-year union is about over. And you think about the whole British Empire owning the planet once upon a time. From the little island, and they've got nothing. And matter of fact, they're losing what they got left.
Right.
So, but the point of that is if Europe's going to watch that, and you start to see this thing unravel, the Germans are very, very unhappy about what Draghi did with these asset purchases, and I forget who the head of the Bundesbank is, but they were squeaking pretty loud, and on some of the votes in the EU anyway, Germany has a veto power on there. They've got, I always joke that they managed to get everything through the currency in the EU that they wanted in World War II. They got largely a control over a lot of economics that happen in Europe. And so, like I said, one day we're all going to wake up, and I remember going back to the '87 crash and everybody waking up. It actually started on the Wednesday prior to Black Monday, and then on Friday the trade deficit came out, and it had been increasing quite a bit for several months, and it had been talked about. All of a sudden, the market participants grabbed onto that one data point and started to panic. Then we had, back in the day, we had program trading, which exacerbated the entire sell-off, and they got involved. And then it was also option expiration, so all the option players got, and it was a massacre. And by the time it came in on Monday, People were still trying to figure out, because back in those days we weren't digitized. We were still doing paper. I remember trading the OEX market that day, and I had direct access to the pit, and the screens were rumored to be up to an hour late. So what you were seeing on the screen happened an hour ago. And on the floor, the guys on the floor trying to execute orders said they couldn't really tell. The market spreads were so large. It was really crazy. And if you've never listened to, I don't know what happened to it. We used to have, it's probably in a forum somewhere, but the flash crash, if you listen to the audio from the flash crash, you'll see that at one stage the S&P had a spread of 10 points. And that's a huge spread, and that's the kind of thing that happened in the crash. So once things start to happen, even with the access and digital access that we have today, and as accurate as we can do things, we've seen systems get challenged, and we've seen a lot of folks try to run through the same door at the same time. When somebody yells fire, it happens really quickly. So, those are the type of things that can just change. But we've this has been I think just about every one of you that I've talked to one-on-one, we've had this conversation about, where do you think this thing ends? And it's going to end. And I don't know, and it usually doesn't end very, very good. And the point of that is, that's what we're finally starting to see. We're probably in the last 1 to 4 months of this particular sequence, and how it ends, nobody knows, but it certainly looks like it's finally starting to roll over. So we could see an elevated cash level for a while. And I've talked about this before, real quick, while we were on this subject, is that only in 2008, maybe in 2001 and 2 to a point, we saw VPM go into really heavy cash. Typically where it goes is where it is right now. You get 50-50, maybe 60-40, 60 cash, 40 exposure from the stock portfolios, which have a lot more dynamics than the individual strategies like our global equity, and those are more heavily in cash. And of course, the only thing we own, like we've talked about before, is the SPY, which is the only thing that's trending. When Mitch was looking at the mutual funds a few minutes ago, the large cap growth is where the position is. That's where you should own. You can see that from our ownership. Plus, if you look at the performance, you see it from there. All you got to do is look at last week's performance on the sheets off the commentary from Monday, and you'll see how the Russell, everything continues to be massively underperforming from a year-to-date standpoint. And from window to window, it might be a little stronger this week, but weaker the next. But the bottom line is, the small cap, the places when we were looking at, Mitch, could you bring up that screen real quick where it shows the different asset classes? I guess the main screen there.
Yep.
I guess where the individual, the equity funds are. There to go. So, we look at large blend and large growth at the big positions. Look as we go down the scale. Mid-cap blend, decent positions there. Small cap, forget it. They're just out. And if you look at those indexes, you look at the stocks in those areas, there's no movement at all there. And so it's exactly how you should be positioned. And I guess it would be nice to be so smart to know to move all the money over to large cap. But I already know the conversation we'd have with all of you. I can't put that much money. I can't allocate 70% of my money to the large, only to large. So diversification, the MPT model, compliance departments for those of you in networks, all of those things end up getting you positioned just like you are, and this is how it looks. And if you have allocations to these mid and small caps, if you're more in a MPT type strategy, you're not doing that well right now, because these things are underwater and those are drawing down. And so the diversification strategy isn't really where it's at. And the best thing to do is how we're positioned, in my opinion, like we are in the global equity, where we have a large amount of cash. We got money to buy if this thing turns around and starts to go up and there's a whole nother leg. Looking at everything I'm seeing, I don't see that happening. Anything's possible. We were at 1,600 having a conversation like this. We didn't have the show then. we saw the thing make a complete rotation and be able to, start a whole nother leg. Here we are at, 2000. So
Right.
there
Stuck
you go.
at 2000 since the 25th.
Yep.
So and you had mentioned, Bob, the drawdowns. When they take place. We had done some research last year on the Dow going all the way back to, was it 1920, somewhere around there?
Yep.
And the average drawdown in excess of 10% only took about 6 months to take place, 6 to 7 months before it had hit the bottom.
Yeah.
And then from that point forward, the recovery rally to get back to that prior high water mark, that could take anywhere from a year and a half to multiple years, like we saw with the last one. So,
Yeah.
I mean, these things happen quick once the sentiment finally does change.
Yeah, and it was like if you go back into the 30s and the Great Depression and the crash of 1929, it took quite a few years. I think it was 12, 14 years.
A lot longer than that. From 1929, from September 3rd, 1929, when it had locked in a high of 386. It wasn't until 1954, November 23rd, 1954. That's a long time later before it finally got back up to that level.
Yeah,
So,
and the stock, it went from 300 to like 17. It was down 87% on that decline. To
89%, it got all the way down to 40
Pretty good
before
guess,
it
yeah.
finally.
Yeah,
back.
so, but, so when these things do happen, listen, I'm not proposing to know how this thing plays out on this central bank situation, but I can tell you this, is that most everything that they've done, they've never done before. No one knows the outcome, whether it's good or bad.
Right.
But certainly to have times where, windows of time where there's elevated risk, if we were running a terrorism meter, it would be in orange or red right now on the market because there's just way too much stuff going on. And then when you start to get, retail guys like Morgan Stanley and some of these guys talking about 3,000, and I remember in the year 2000 that everybody thought the market was going to go up forever. Well, forever was until about April, and then it was all over. So it takes a while for market sentiment to get crazy and frothy like this, and I think we're there, but it's just a matter of how this thing ends up playing out the end. But like I said, I'll go back over to kind of summarize the last 8 minutes here and talk about a couple charts I didn't look at earlier. So I'll go back on screen here. And one of the couple of charts I usually look at, the magical charts of the international, the EFA versus the S&P and the EEM versus the S&P. You can see they've made further, the spread has went down further, which means that those two markets, EFA and EEM, are underperforming versus on a ratio basis on the S&P. So I'm convinced when this chart looks like it's going up, that everything's getting unwound. The money that there's been all this tells you is a story, is a massive amount of money for the last 5 years has flowed into the U.S. markets. And now that you've got the dollar stronger, it's funny because people are talking about the dollar being strong like that's bad for the stock market. If you're sitting in Frankfurt and you own stocks here and the stocks are flat and the dollar goes up, you're making money. I've traded from other countries and other currencies before, and if depending on what currency you own, it gives you a completely different perspective. So a stronger dollar will attract a lot of capital, especially if things are, you got the euro going down. Let's see, I think I'll own German stocks. They're going down, and my euros are going down. That sounds like fun, and they're not going to do that. They're going to continue to put money here till it doesn't make sense. I've said this before. When you watch these shows, when these guys are talking about, well, they want to be in cash, but they want to, if they're going to be in cash, they're going to own dollars. And I had the opportunity to work in the markets offshore once upon a time, and it was like an eye opener that you can't believe. There's a perspective beyond the U.S. perspective when you're here. Real quick, running over here and taking a look at the cycles here. I've got the hourly cycle up on the screen. We have a cycle coming in toward the end of the day today. I'm sure that'll probably be a low, and we'll rally back up to unchanged. But we'll see. We're only off 471, but it almost looks like nobody's home. I've been watching a little bit on the movement here. I'm going to bring over the webs here on this basis. Let me change this over to a 5-minute graph real quick. 5 minute. You can see market decline. We rallied up, and now we're pretty much laying along the bottom. Over on behind me here. Let me get off screen for a sec. You can see this scale. The low is 99.25 on the futures. We're now 202, so we're roughly about 225 points off the lows. We were down 6 handles on the S&P, so not a lot going on. It's just kind of floating along the bottom here. And going back over to the hourly graph, let's look at the short-term graph. And these cycles aren't really hitting very good right now, but there is a cycle due right now, roughly. And we'll see if this market starts to move up and recover a little bit, then it's probably going to recover into the close again today. So I always try to give some perspective on how this thing's going to finish up. My guess is sideways, we probably end up negative. We've taken out the key. Well, we have a 1999.80 was the key number today. If it took that out, that would confirm a lower price. We have not done that yet. But the other thing that's happening here, if you look at the daily ranges, we're looking at right now, we've got a range on the S&P here of 2,087 to 0717. So we're under 6 handles. So the 3-day, the 1580 number is going to shrink again. It'll probably be back to 12 and change. If we stay quiet for the first few days, we're going to be right back into those doldrums, and this thing just hovering around this 2,000 level as it looks. So from that standpoint, not much going. Really, not much to really talk about there. One of the other charts I haven't brought up for a little while. This is, and we need to do a show on these one day, because especially once we get the TradeStation stuff out. One of the things that is planned, every screen that I use in the show, every screen I use for my analysis, I'm going to be putting out in even a zip file or some kind of install file that you can put in if you decide to try out the TradeStation MarketMind, that you'd be able to take all these screens and you'll have every indicator and everything that I use for my analysis every day. And I know a lot of folks over the years have wanted something like this, so we have it out there, and then I'll be doing some shows. But this particular screen here is what I call the webs, and they're really about pattern recognition and understanding support and numbers. And the type of thing that we're seeing here on this chart is really where this thing starts to form potentially. I'm looking right now, and I'll talk about these formation, one of these, what I call a diamond top, and I'll go through all this stuff in an appropriate venue. But the bottom line is we're looking at this thing is probably going to start etching out some sort of top, whether it's significant or not, we'll see. This is the weekly, that webs on a weekly basis. They've already been crisscrossing here, which suggests there's a substantial amount of resistance overhead. And that's a lot of times when you get to be, I guess, a seasoned player like I am as far as technical stuff, when you see elements, everything from my from VPM database, from all the elements that I see, from all the analysis techniques that I use, I know what these things mean in the probabilities. So it's sort of, it's like anything. When you become a professional, you can really get a feel for what's going on. I'm not bragging. I've just been doing this for 35 years. So if you're not good now, you're never going to be good. Okay, and it takes a lot of years to figure out a lot of these things. But these particular, I put these together in 1994. I started using this particular formations to see this, and this is we're at least at one of those points where the markets have a lot of resistance here, and the likelihood of them getting through here is not much. And we're seeing, I was talked about, I think in commentary about the VIX getting up to about 14, and I think that'll start to increase, which tells me there's a little bit of downside, whether it's the 1980 that I talked about earlier in the show, 1991 to 1983.70 is the extreme for the week. So we'll see how that all plays out. So we got about 30 seconds to go. So we are going to continue this week on our Monday-Friday routine. And then next week, we're going to be announcing a new schedule and some of the things that we want to do with you folks in continuing a perspective. And I'm pretty sure we're going to have Market Mind and some other stuff to go through. And that we're hoping to get that web release out here in the next few days, but we'll let you know. And then expect to see sometime before the end of the week, both on the website somewhere as well as in email. So please read your emails from us. I know a lot of you don't. But if you do, it would be really helpful. And what we're going to tell you is about how to make sure you get into this show next time. And when you log into our website, you'll be able to see that as well. So all this time I thought I was on screen, I'm off screen. But anyway, it's time to go. Thanks again for watching, and we really appreciate it. If you're streaming, please give us comments. Please tell us what you want us to do. Sometimes we do our best at coming up with things, but that's really what we're looking at. So thanks again. Have a great day. We'll talk to you on Friday.